Hello there. We've seen another volatile couple of months on the stock market, but it's been a little bit different from some of the previous volatility we've seen. Investors have started to turn their attentions to what happens in the event that economies really start to recover, that they reopen, that hopefully as the vaccines get rolled out, the pandemic dies away and we get back to normal. And of course that's great for certain types of stocks. Some of the companies that have been really hard hit by the pandemic stand the most to gain as the economy recovers. And that's one of the reasons we've seen the FTSE 100 do quite a lot better than some of the other markets around the world over the past couple of months. The FTSE's got lots of things like oil companies and banks that will do better in a growing economy and have struggled through the pandemic. But it's meant that certain types of stocks, in particular in the US, some of those big tech names we've talked about in previous videos, have actually really struggled because they've been the big winners out of the pandemic. And as the economy reopens, perhaps people will stop using so much technology. Maybe we won't be on Microsoft Teams and Zoom quite so much, won't be buying so much from Amazon. But there's also a knock-on effect from the bond market. As the economy recovers, naturally we'll start to look at what happens to interest rates. And so what we've seen recently is that bonds have seen a bit of a sell-off, government bonds in particular, things like gilts and US treasuries. The yields have gone up to reflect the fact that interest rates will have to go up at some point in the future. That doesn't mean we think they're going to go up in the next year or possibly even 2 years, but they start to reflect what might happen in the future as the economy recovers. And that has also had a knock-on effect to some of those stocks that I just mentioned before, some of those big tech stocks or other names who tend to grow their earnings, their revenues much more quickly than some of the other companies in the market, but currently trade on really high multiples of those earnings. They're quite expensive, and so what we're looking for is the future growth. And for a few kind of technical reasons, as bond yields go up, the discount rate that we use when we look at those stocks goes up too, and that essentially means that they're not quite as attractive as they were. So what we've seen in the market is a bit of a rotation with some of those companies that have struggled through the pandemic doing well, and those that have been some of the winners out of the pandemic starting to struggle. So from our point of view, we've got to make sure we get that positioning right within the portfolios and get that balance right, because of course this economic recovery is not a given. There are obviously risks if the pandemic takes hold again, for example. But all this kind of turn of this attention that has been turned to economic recovery has got people thinking about inflation again. And we do think inflation will go higher in the short term, just simply because prices this year will be a lot higher than they were this time last year. Because in that time we were in the middle of the pandemic, prices were depressed. Inflation's always a year-on-year number. So we have these base effects that make it look a lot higher, even if we just recover to the sort of levels of prices we saw pre-pandemic. But also we think, there's a lot of pent-up demand out there. There's a lot of people who perhaps have excess savings because they've not been spending as much, that just can't wait to get out there and spend when the economy reopens. And I have a lot of sympathy with that. So that might well cause short-term supply and demand imbalances which could lead to more short-term price increases. So we do expect inflation to be a bit higher in the short term, but longer term, we don't really see any reason why that would become entrenched. There's still a lot of capacity, we think, in the economy. There's unfortunately still a lot of people out of work, and there's a lot of people still furloughed that don't know whether they're going to be in work once the pandemic is over. So still a lot of uncertainty. But from an investment point of view, as I say, it's just making sure that we get the balance right between those stocks and assets that benefit from an economic recovery, and those that are kind of protect us against inflation should that become an issue. But also getting that balance in case some of that doesn't happen, thinking about the risks and making sure we look after those as well. So thanks very much.